Alright, in this video we're going to break down the comparison of Roth, whole life insurance, and index universal life insurance. Now, I do all three of these, so this is me and my own experience in comparing these products, and I'll tell you off the top, if I was only going to choose one, it would probably be an IUL. And in order to really understand that, you have to watch this entire video because it really is complicated as to why I prefer this over both a Roth or a whole life or most other vehicles. I mean, so traditional IRA also applies, 401k also applies. I use these things in conjunction with real estate, so I don't really compare those. But in my case, I would choose an IUL likely if I was only going to do one for my personal circumstance over whole life or Roth. That doesn't mean that in every circumstance that that's what other people should do. There's a lot of different reasons for why that makes the most sense for me, and we'll get into that in this video. There's two parts to this video, so if you want to see the other video in this series, then check out this link up here or the video description or top comment. And why I'm comparing to a Roth is because of the qualified account types. I think it's the best, and whether it's a Roth 401k or a Roth IRA, which I do both of those. I do a Roth 401k and a Roth IRA, but I do the Roth IRA through a back door because I have to. But I choose that. I still have other traditional instruments, but I don't like those as much because this traditional idea that somehow in my retirement I'm going to be making less than I am right now, it's just not going to be the case. I'm doing pretty well, and I will continue to do well. I'm pretty confident I will continue to do well, or even better. And over time, I will continue to earn more. And so, yes, by doing paying taxes on the harvest, you can say, paying taxes on the seed versus the harvest with the Roth or whole life or IUL, really, you're really talking about paying taxes on the seed rather than the harvest. And so, yes, if you pay taxes on the harvest, you can possibly have more seeds to plant, have more growth inside of that. But in the end, when you access it, you're more limited in how you access it, and a number of different reasons. I'm not going to get into that in this video because this video is going to be long enough with all of these comparisons, but the reason I'm comparing these three vehicles is because they are my preferred instruments, and it's not to say that I don't have the other things. I have some funds in traditional 401k, and I have plans for eventually, rolling that to a Roth instrument. There are tax strategies that you can do to do that successfully. There's a number of different things, like I have multiple brokerage accounts, so I do have some things that don't really have any benefits, and those accounts are used for just quicker access to just not have funds sitting in places. Also, by having certain levels of in certain types of accounts, like I'm a Chase private client because of the amount of funds I have in my Chase accounts. I'm Bank of America preferred because of the amount of money I have in those accounts, and there's reasons why I like having those preferred statuses. All of that's sort of side topic. Today's video, we're talking about this comparison of these three vehicles, which are my favorite vehicles, and we'll get into why I would choose the IUL if I only had to choose one. Starting out, let's look at this first row here, the potential returns. We're going to go through a few more of these, and then I'm actually going to break down a little bit of an explanation on how IUL returns are, or how you get them. Obviously in a Roth, when you can invest directly in stocks or in whatever securities, ETFs, mutual funds, your potential is unlimited. In my Roth account, I actually do some options trading on top of my ETF and stock fund trading. So there's unlimited returns that you can have inside of a Roth, and that's why I love it. I can do lots of different trading knowing that I will never have to pay taxes on those funds ever again. So that's why I really do like it. Potential returns are extremely high. Now, whole life, 4 to 6% annualized returns over the life of the policy. So, in my case, I'm in my 30s, my mid-30s. I'm funding, at a level very close to my limit for the policy that I have in place, and I should be able to reasonably expect a 4 to 6% annualized returns until I'm like 100-something years old. I think that's a pretty good return, and there are ways we tax-free access it. We'll get to that here in a little bit. With IUL, I have a more in-depth video on indexing strategies, and we're going to actually touch on a few of them in order to explain some of this as well. But over the long term, I can reasonably expect 8 to 10% annualized returns. So what are the minimum returns? Well, in a Roth, you can potentially lose all of your investments, your contributions, your earnings, all of it. If the market goes to zero, then if that were to happen, I mean, in all honesty, probably every one of these vehicles would struggle. Or whole life companies, you'd see whole life companies probably having challenges, and same thing with IUL. If the situation happened that you lose all of your investments, I mean, unless you're doing crazy investments, if you're just like putting it all into penny stocks, that's a different story. But if you're putting into index funds and some secure, safe investments, and reasonably secure long shots as well, I have some higher risk direct holdings in stocks as well. And the reason I can do that in my Roth, and the reason I choose to do that in my Roth, none of my Roth is in any kind of secure investments like bond funds or dividend growth funds. Actually, I'm probably going to put some into some dividend growth. For the most part, I'm in higher growth instruments in my Roth because I have the whole life. So the whole life insurance is what makes for me I no longer put into bond funds because I have a significant portion of my income going into a whole life policy. And similarly, IUL, you have downside protections. So personally, with the strategies that I use, 0% or 1% loss is the floor. So either 0% floor, which it still ends up being a minimal loss because you're paying cost of insurance, and then 1%, which would mean it's slightly over 1%, 1% some change, if you did have a market return that was like that. I do have the option to use this 0.9% guaranteed return, so there could be a guaranteed return within my IUL. I'm not doing that, and we'll get into that more as we get to the indexing strategies explanation. So, funding limitations. With a Roth, for my age, $6,500 is all I can contribute for this year. It's 2023 right now. Last year it was $6,000 for a Roth directly. With whole life, it's based on how much death benefit you can qualify for, and same thing with IUL. So there are ways that we can cheapen the insurance, using term riders and things like that, and then so we can pump in more cash. But it's all based on how much money you can put in is based on how much death benefit you can qualify for, in order to keep that tax advantage status of not being a modified endowment contract. I'm not going to cover all the ins and outs of that, but there's not really limits for most people. For most people, I think putting in millions of dollars per year is probably good enough. That sort of connects to this income limitations thing. So for Roth, you can't, if you're married filing jointly, for 2022, your MAGI can't be higher than 214K, but even at that point, it's already reduced the amount that you can put in. And then for 2023, it's $228,000. That's a limitation based on your income. For whole life and IUL, it's a multiple of the death benefit is a product of a multiple of your annual income. So if your income is lower, then you'll qualify for less of a death benefit, and as such, you don't qualify for being able to put in as much. And also, most of the carriers will not want you to put in more than 25, 30, 40, maybe as much as 50% of your income, but like most carriers have limitations on what percentage of your income they'll let you put in. But there are some workarounds on that as well. So with Roth, the income level workaround is a backdoor Roth. This is something that I do. I do a backdoor Roth. Because it makes sense. I'm not going to get into the mechanics of actually doing that, but basically you contribute post-tax money to standard IRA, and then you just do a conversion. With whole life and IUL, there's not really an income level workaround needed because you can generally qualify for more death benefit than you're going to fund at. Funding level workarounds. Well, with Roth 401k and Mega Backdoor Roth, you can put large amounts of money in. In order to do some of this, either your employer has to support it, or you have to have a company plan that supports it. Like with your own company, you can do these things. But yeah, you can put in up to $60,000 or $70,000 per year into a Mega Backdoor Roth if you are able to do that. With whole life, we attach these term riders, and same thing with IUL. Both of these things, we attach these term riders to fund at extremely high levels. And that's what allows for us to get such crazy growth, and we can also fund at those higher levels because we always have access to it. We're going to get more into that here in a bit. So you can fund at very high levels with whole life and IUL for the most part. If you're tired of the same old advice of just buy index funds and forget about anything other than pinching all of your pennies to make sure you achieve financial independence, then subscribe to keep up with our content. I'm all about building out income streams, unconventional wealth growth strategies. That's the kind of content that I put out. I also do index investing, but that's only one part of my overall strategies. So Roth doesn't have any kind of health considerations. You don't have to worry about that with a Roth. With both whole life and IUL, there are considerations. If you can't qualify for life insurance on yourself, you can't you can't get death benefit, and then that means you can't get whole life or IUL for yourself. But there is a workaround for that. So if we go and see here, we can obtain policies on another person for whom you have an insurable interest, like children or grandchildren. And that can be a way that you can still have cash value growth with these things without the policy being on yourself. Ideally, you're doing it on yourself first. So that's something that you should do. So because it's more likely that your beneficiaries will receive that death benefit first. You are likely to pass away first. So that is preferred. In a Roth, you can access your contributions at any point. And if you want to access your gains, then you will have to pay penalties and taxes and things like that. So that is a consideration. With whole life or IUL, this is a big one, right? So you can tax-free access to the funds paid in, so the premiums paid in for whole life or IUL, but you can also access the gains through policy loans. And in the case of whole life, you can usually get an IBLOC, insurance-backed line of credit. So this is why I can fund these policies very close to my amount of take-home pay. Because at any point, if I needed to fund something, I can access within a couple of days, $150,000 if I want to access them and not impact my compounding. Access later. So after 59.5, you can access your Roth pretty openly. Like you can use the funds really openly. That's a great thing. That's why I love the Roth. You can really set up a good income that is tax-free, that you can rely on and not worry about whether or not the government raises tax rates. So again, tax-free access through whole life and IUL through policy loans, but also you can access the premiums paid in up to your cost basis. I don't actually prefer that until in whole life. Maybe later on, like in when you are sort of drawing from them, I do think it makes sense. Like 30 years down the line, I might actually do partial surrender or with effectively a withdrawal of my parts of my whole life. I likely won't do that with IUL, and I'll talk more about that. You can probably already see that in this. So if you want to buy a home with a Roth, you can do this one-time $10,000 limit thing to buy a first-time home purchase. So it's pretty limited, but again, you can use up to your contributions. So when you combine those things, that's not bad. So if you fund a Roth for a number of years, it's not a bad thing. But with whole life or my IUL, either one of these, I could fund the entire purchase of a property through a policy loan. And then I have other videos on using policy loans to do initial purchases and then cash out refi to pay off the loan to the insurance company using things like the BRRRR strategy. But I'm not going to get too deep into that in this video. Check out, I'll leave playlists different places. So if you want to check out some of my videos on that, you can.